Okay, so for part one, what we're going to look at is what I'm calling the mortgage market chain. It's very important to understand that the current financial crisis is not an isolated issue in mortgages. It's not an isolated issue to subprime mortgages. It's not even an isolated issue to reselling packaged subprime mortgages in the secondary market. In order to grasp an understanding of a complex problem, you have to understand the complexity of the market. Let me start over here on the left. First of all, what you have on our number one here is brokers and bankers. Now think about mortgages for a second. The foundation of a mortgage is a person is buying a house. So let's keep it very simple. I'm going out to buy a house. I find a house that I want, and I'm going to pay $200,000 for the house. The next step for me would be to become qualified to buy the house if I don't have the cash on hand, which most people don't when they're buying houses. They do put a mortgage up. They do try and shop for a mortgage before they buy the house and get pre-qualified. So if I need $200,000 to buy a house that I want, usually I'm going to go to one of two places, usually, and that is to either a bank directly or to a mortgage broker who works usually for a bank and think of it kind of as a feeder system, an extension of the bank, in order to generate these mortgages so that people like me can get my $200,000. Well, we'll talk about this in a future lesson, but to keep it simple, there's various types of mortgages. And in the recent financial situation we've been going through in the last 5 or 6 years, it now being 2008, since probably the early 2000s, mid-2000s, 2003 and 4, some of these financial mortgage instruments have become quite creative in allowing people like me to get my $200,000, which we'll talk about in a future lesson. But to understand it now is, to understand the first piece of this market chain, if you will, is the brokers and bankers. So these are the folks who are originating the mortgages, who are approving me. They're looking at my credit rating, they're looking at what they think is my ability to repay, and they are then qualifying me for a mortgage. Once I have the money, then I can go and pay either the builder who's building my house, or I can pay the owner of the house if it's a house that's pre-owned, and then take possession of the house and live in it. And then of course I'm responsible to make my payments on my mortgage, whether it be a fixed rate or an adjustable rate. I'm responsible to make those payments because I've entered into a legal and binding contract to do so, and it's anticipated that I'm going to make those payments. Now that's extremely, extremely important to understand, because when that breaks down, that explicit guarantee that I'm going to make my payments, that contract breaks down, the entire mortgage chain begins to falter. And that's exactly what we're living through, and we'll talk about that more as we go on. So just remember these main points, that these brokers and bankers, they issue the mortgages. In other words, they're issuing what we're going to call from this point on paper, mortgage paper. Basically a contract that says, John is going to pay back his $200,000 on this mortgage for this house over time at certain payments every month. And there's the terms of that contract are explicit in it, and I'm assumed to be responsible enough and creditworthy enough to make those payments and pay my mortgage back over time. Now, one of the major things to remember about brokers and bankers is that what they do with this mortgage paper, with these contracts, is they package them, they bundle them together in order to resell them. The $200,000 mortgage that was originated for me, the bank usually doesn't own. The bank has it originated and then will turn around and get Mary's and Dave's and Steve's and Jim's and Tim's, all their mortgages as well that were originated about the same time, and bundle them together and make what's known as a security out of them. And this security is then sold in what's called the secondary market, and we'll talk about that in a second. So it's important to remember that brokers, which are extensions of the bank in order to originate loans, especially mortgage loans, and the banks themselves don't necessarily, and neither do they want to, and I'll talk about that in a second, neither do they want to own the mortgage. They want to originate it and resell it. The reason they do is because they want to, first of all, get the fee income from reselling that, and secondly, the bank doesn't want to hold those mortgages as assets on their books because they have to raise additional capital in order to fund those mortgages and keep them as their own assets. They'd much rather originate them and then resell them in the secondary market, get the fee income, and also servicing income. So it's important to note that the banks have a disincentive to hold mortgages on their own books. So when my mortgage is originated by XYZ Bank in a certain town, that bank is more than likely not going to hold that mortgage. They're going to resell it for the fee income. And there's two main reasons they're going to resell it and not hold it. Number one is it costs them money. They have to raise additional capital, again, to hold that mortgage. If you remember Banking 101 in economics class, you remember that banks hold about 10% of what they loan out. So if a bank has $1 billion, they're going to loan out $10 billion. They're allowed to hold. They're going to hold about 10% in reserve. They have to legally, and then they'll loan out the rest. So if a bank then starts originating mortgages, say they originate $10 billion in mortgages, guess what that means? They've got to go get capital to capitalize those mortgages and hold another $1 billion in reserves. And that costs money. In order to do that, you have to raise that, and it costs money to do that. So there's a disincentive for banks to hold mortgages in large volume, large loan assets on books. The second reason why banks are disincentivized to hold the mortgages is because of the loan losses. Every loan that's created has a probability, be it may small or large, depending on the quality of the loan, of it going bad or going default, or in essence the customer not being able, or necessarily in our day being willing, to repay. So if you packaged 100 loans together, you might have a loan loss rate assumption built in that 5%, for example, may not pay back or may go default at certain periods of time down the road. So loans are especially tricky because you don't know when you originate them, when or who necessarily is going to default on you. But you have to build an assumption of default in your loans. So if I pool a bunch of loans together, say these securitized loans that I was talking about, the 6 that I think I mentioned, and tried to sell them in the secondary market, there's an assumption of risk in the paper. There's an assumption of a loan loss risk that's going to come in, build into the paper as it moves along in time. The thing that the bank does, the second disincentive for the bank to hold the paper, is if it did hold the paper, it would have to realize the loan losses, as well as, of course, increase their funding in order to fund those loans. So there's two pretty big disincentives for banks to hold any large loan asset on books, but especially mortgages. So what we see here in this little chart is you see that, and if it's hard to see, you have houses down here. Each one of these houses generates a mortgage, one piece of paper. Then they're packaged into a security and securitized in the secondary market. And then banks are incentivized because they get a fee for reselling these. They're going to get money based on what the secondary market believes the cash flows are, minus the risk coming from these investments. So this is the first piece right here, is just having a good understanding of the brokers and bankers and what their job is, and why banks don't necessarily want to hold mortgages. It's very important to understand because the entire issue that we're running into has its foundation in the quality and the riskiness of the mortgages that are generated.